Life. I just don't see myself. Whoop. Okay. All right. I don't know what's going on with the system, but I guess the Research Investment Committee, let me give you some insights about what are the tax efficient upgrades hiding in plain sight as of today. Key takeaways. Number one, this year of the bond is bullied by higher growth and inflation. So we're staying quality stocks, prudent yield, credit, and commodities. In terms of managing your portfolio, this is basically what's happened. If it's not, then think about this for a minute. Number two, tax day is coming, right? After $1 trillion of household bond buys that were done in 2023, the bill coming due may spark a retreat to equities. Some tips. Number three, own one ETFs, mutual funds, stocks, bonds, prudent yield, benchmarks for buybacks, dividends, MLPs, QDIs, and CEFs. This is a conversation you should have with your portfolio manager, and he will explain to you what these are. So, what is the outlook? It was supposed to be the year of the bond, but treasuries are on pace for a 13% loss. And with super core inflation, which is greater than 4% and rising, Fed cuts are really that favorable for fixed income? It's a big question. We prefer quality equities, prudent yield credit, and scarce commodities. The universal tax. This is a good one. Your CPA is the best person to talk to about this. Now, US federal debt would likely exceed 100% of GDP in July. Soon, this is going to surpass, or will be surpassing what World War II peak was. Almost 90% of the budget rises automatically. How does it end? Not with drama default, but with taxes and with the hushed acceptance of that universal tax, which is, inflation. So, what are the 5 ways to make your portfolios more tax efficient? And this is something I already wrote here, but in the description box. Number one, it's March and tax day is coming. So, ideas to start the conversation with your tax professional starts now. Number one, investment products. The average exchange traded fund or ETF saves about 1 point per year versus an identical mutual fund by avoiding taxable events. Number two, asset allocation. Households bought $1 trillion of treasuries and money markets in 2023. All those interest payments are taxable as ordinary income. Example, at 37%, as the tax bill comes due, the 20% capital gains rate for equities is more attractive. 3, fixed income. A prudent yield sector offers 6% tax adjusted yields versus just 3.5% for the US Aggregate Bond benchmark, which means the high yield munis are key. 4, equities, buybacks, beat dividends by 4 points per year through low friction compounding. And 5, the rest. Ideas abound if you know where to look. We are flagging MLPs, QDI, and CEFs. Again, this is a conversation to have with your portfolio manager, tax professionals, not your lawyers. Anyway, I hope this helped. I know you guys are right now closing up the year, and this is good information for the time being to readjust your portfolios. Any other questions? You know where. Corporate at SORIANOgroup.com. As always, take care, guys. Thank you. And we're going to put this away and end this stream.